Sometimes you get experienced life insurance sales executives who intend on switching or rather exploring opportunities when it comes to general insurance. So this is a key video which will help individuals mainly specialized in life insurance easily transit or rather explore additional opportunities when it comes to general insurance, or partner with us here at Online Advisors Insurance Agency, where we are licensed independent insurance agents mainly specialized in general insurance. So the first step when it comes to general insurance, you need to be able to differentiate it from life insurance based on the term limits. Unlike life insurance, which policies run for a longer period of time, when it comes to general insurance, any particular policy runs for a maximum of 1 year. So at the end of this year, the client has the liberty to either renew this particular policy or fail to renew the policy, and automatically the policy becomes inactive. Different types of general insurance. Some of the key popular general insurance products within the Kenyan market include motor insurance. We also have medical insurance. We have personal accident insurance. We also have different types of liability insurance, such as professional indemnity insurance, director liability insurance, and other different types of general insurance products, such as travel insurance. In this video, for purposes of simplicity, we are going to focus on motor insurance and medical insurance. It's also important to note that most of the other products will mainly require a customized quotation for you to be able to advise clients on how much they're supposed to pay for those particular policies. So without wasting time, let's dive into motor insurance. When it comes to motor insurance, we have different categories. First, based on the scope or rather the range of coverage. So any particular client can purchase either of these three types of motor insurance. The first one is third party only, commonly referred to as TPO. So for this particular cover, one is only insured against liabilities for losses caused by their vehicle to other people's vehicles, property, or life. Next, if they don't need this, they can upgrade it to third party, fire, and theft. So in this case, you gain the additional benefit over and above being covered for your third-party liabilities. You're also insured against losses to your own vehicle as a result of either fire or theft of your particular vehicle. Finally, one can purchase comprehensive insurance. So for comprehensive motor insurance, here the vehicle owner is insured against third-party liabilities. He is also insured against losses arising from fire, theft of the vehicle, and finally from accidents. So losses related to accidents are only paid if you have a comprehensive insurance. So it's also good for you to be able to know that in the event that your vehicle has a third party only cover or a third party fire and theft cover, the only way you can gain compensation from an accident claim from another vehicle is by you suing the other party, in which case you then become the third party for their particular policy. The meaning of a third party is someone who is not you as the vehicle owner and is not also your insurance company or insurance service provider. Within the Kenyan market, however, this second type of cover is rarely purchased or sold. The main reason for this is that the cost of you getting this cover is almost similar, or rather there's a very little difference in terms of payable premium for you between you purchasing this and this. So many, or rather most clients generally purchase either comprehensive or third party only. Okay, now once you have a clear understanding of this, you also need to note that not all vehicles are equal when it comes to motor insurance. They are also categorized based on the nature of use of their particular vehicles. So you can purchase either of these covers for either of these vehicle categories, which I'm about to list. The first category is private. So you purchase private motor insurance if your vehicle is primarily used for leisure or you running your own personal errands. Next type of vehicle, we have commercial. So for commercial vehicles, this includes pickups and other commercial trucks or institutional buses, which are mainly used for business purposes. So this can be transporting your staff or carrying products or service or products for either sale or for transport services. So commercial is mainly categorized into two main areas: own goods and general cartage. So own goods is for vehicles, or rather commercial vehicles used to transport goods which are solely owned by the insured, which is the truck owner or the vehicle owner in this particular case. General cartage on the other side, this is for the case where the vehicle is used for both transporting your own goods or goods belonging to other people. So in this case, you paid transport fees. One key important distinction between this is the premium in most service providers. So general cartage insurance is generally more expensive than own goods due to the high exposure in terms of risks. But it's also important for you to note that when you have general cartage, you haven't insured the goods being transported. It's basically insure the truck only in this particular case, as it is with own goods. So the difference in rates is mainly related to the risk exposure. Number 3, we have PSV, chauffeur driven. So this case, these are the online taxis where you can find a taxi operating using the online platforms. They have this particular type of insurance which is specified to their nature of business. It's good for you to note that this cover is sold by fewer companies within the market, also due to its risk exposure. When it comes to any type of PSV, there's an additional premium which is paid, which is referred to as a PLL, which is a passenger legal liability. So it's mainly paid as based on the number of seats within that particular vehicle, or rather the passenger carrying capacity of that particular vehicle. You also have PSV taxi. Now for the ordinary taxis, we also have PSV matatu. Now this is for the PSVs operating as minivans or buses purely for public transport. And we also have motorcycles. So it's good to note that for motorcycles, we have both private and border. 7, we also have tuk-tuk. So for tuk-tuk, they can be private, commercial, or PSV. So basically those are the key types of motor insurance, I think, which you can be able to encounter within the market. Any additional type of cover might generally fall within these particular categories. So one important thing which you've mentioned is passenger legal liability, which will apply for any PSV type of motor insurance. So taxis, matatus, boda boda, they must have an additional cover for the passenger legal liability. So now at least you have a key foundation in terms of the types of motor insurance which can be able to purchase and the different types of vehicles within the market. It's also good to note that these insurance covers also have different colors, which makes them easily identifiable once attached on the windscreen of any particular vehicle. So for example, private is green, the commercial is blue, and PSVs are more or less brown in color. Okay, now with that in mind, next let's look at premiums or pricing. So premium is the amount which customers pay for them to enjoy insurance services, or the exchange which they pay to the insurance company for them to enjoy these insurance services. So in case a risk occurs, or rather a loss from an insured risk occurs, they'll be able to be compensated since they paid this particular premium. So for these premiums, when it comes to third party, it's more or less fixed and irrespective of the model or value of your car. So for private vehicles, you pay a fixed amount irrespective of the value of your vehicle or the make of your vehicle. For PSV taxis, you also pay more or less a fixed amount plus PLL times seat capacity. So let's say PLL in most cases within the Kenyan market is 500 shillings. So let's say you have a four-seater, so that will be 500 times 4. So the fixed amount plus the 2,000 at any particular time. What becomes different is the PSV matatu. So for PSV matatus, this is offered by very few companies within the Kenyan market. Currently, less than 5 companies offer this particular type of cover. So this is usually quite an expensive cover due to the risk exposure and can be paid either after for a cover for 14 days, 30 days, or 1 year, or installments. So different monthly installments. Now for this PSV matatus, unlike the other types of vehicles, if they need a comprehensive type of cover, they need to ensure by purchasing this PSV matatu cover and insure the asset separately, not in a motor policy, but as a motor asset. So that's a more complicated term, which you can be able to dive into later on as we proceed. Now, for commercial vehicles, the payment of the premiums is mainly based on tear weight. So this is the weight of the truck or vehicle when it's not carrying any particular goods, and this is indicated in the vehicle's logbook. So different companies have different ranges in terms of, for this particular range of weight, or rather tear weight of your truck, this is what we charge. So the higher the tear weight, the higher the premium which will be charged for the third party. Okay, when it comes to comprehensive, in this case, the value of your vehicle is very important, and some insurance companies also look at the model and make of your particular vehicle when it comes to their rating. So each company has their different rate cards when it comes to comprehensive insurance. So it's good for you to be able to explore different options and advise the client appropriately based on their vehicle model and the different budgets which they're willing to pay for their particular motor insurance. So in this case, it's mainly a percentage of the value of your car, a percentage times value. So the way this works, your vehicle has to be valued by the insurance company, where the insurance company won't charge you for the valuation fee. But what happens in practice is that they expect you to pay for the first month installment, which is an estimate of the annual premium. So in most cases, they tell you to pay around 30% of the expected annual premium which you are to pay. So let's say the premium which you are to pay was 100,000. They tell you to pay 30,000 first. They give you a 1-month certificate and a letter for you to take your vehicle for valuation. Now after valuation, you come again and recalculate the premium based on the valued amount and not the estimate which you had used earlier. The premium which you get, you simply subtract what you had paid for the first month, and once you pay the balance, you're able to get an extension for the remaining 11 months of your cover. Some companies also offer you the ability to pay the balance in 2 months installments. There you can pay maybe another 30%, get another 1 month cover, and finally pay the last balance and get the remaining 10 months cover for a particular vehicle. However, there are also additional benefits which you can purchase over and above the standard comprehensive motor insurance. So the first benefit is mainly referred to as excess protector. Now, excess refers to the part of the claim which you as the vehicle owner has to incur, or rather pay, in terms of the cost of the loss. So let's say your vehicle had an accident and your insurance company requires you to pay an excess of, let's say, 5%. So this is 5% of, let's say, the value of your car at any particular time. So you find that you, over and above having comprehensive insurance, you still have to pay a certain amount once the loss occurs. So let's say the cost of repair is 400,000, insurance company might expect you to pay let's say 100,000, and the insurance company pays the balance. So if you don't want to pay this excess, you purchase an additional cover which is referred to as an excess protector cover. By paying a small amount, you're insuring against the loss of paying excess in future. Another benefit which you can purchase is political violence and terrorism benefit. So this is an additional cover which helps you get compensated in the event the loss arises from political violence or terrorism. In the event that you don't purchase this additional benefit and the cost of loss to your particular vehicle when you have comprehensive insurance as a result of political violence or terrorism, your claim won't be paid. So this is a key benefit which some companies nowadays include it in the standard cost for their particular insurance product. You can also purchase an additional benefit such as courtesy car. This mainly applies in private motor insurance. So in the event that your vehicle is garaged at any particular time, the insurance company is able to rent out a vehicle for you to be able to use while your vehicle is within the garage. So in most cases, this courtesy car goes for around 10 days. So it gives you a car to use for 10 days as your vehicle is being repaired in the garage. You can also get additional benefits such as road rescue. So these are different service providers who are able to sell their services in partnership with the insurance companies. Some more advanced companies can also offer you an additional benefit such as loan repayment insurance. So this works in the form that in the event your vehicle is on loan, or rather you're paying a loan to the bank, and the vehicle is garaged, let's say more than 30 days, for any additional day, the insurance company will be able to compensate you a certain amount, which will help you go towards the repayment of your loan while your vehicle is still within the garage after an accident. Those are some of the key benefits which you can be able to purchase at any particular time. And once you get the premiums for these additional benefits, you just add them to the gross premium which you got here, and you get the total premium before levies. So it's good for you to note that for any insurance product, there's a standard levy of 0.45%. So some people go wrong by multiplying this to the value of your car, which is wrong. This is as a percentage of this premium. So whatever amount we got here, we multiply it by 0.45, we get the levies here, then we add a stamp duty of 40 shillings. Now with this, once you add the total premium which you got here, plus levies, plus stamp duty, you get your total payable premium, which the client will pay for your comprehensive insurance. Now, when it comes to rates, different companies have the different rates, and if you're interested in further exploring sales opportunities, you can visit any of your intended general insurance service providers. If you're a licensed agent, you can open your account with them and be able to sell their particular products. However, if you're also interested in partnering with us, where we can have a mutual agreement as independent insurance agents, you can become one of our consultants, where we are able to partner with you here at Online Advisors Insurance Agency, and we'll provide you with different rates from different underwriters and different insights in terms of their claims efficiency and our network to the different service providers working within the Kenyan market.